Good day, everyone. My name is Ted Gardner. I'm one of the portfolio managers on the Westwood Salient Energy Infrastructure team. Today, I'm going to spend a few minutes reviewing February performance, talk a bit about the implosion in natural gas prices, and then close with a brief review of fourth quarter earnings. In terms of returns, February was a rough market for markets overall, and our space was no exception. All three midstream indices were negative for the month, although MLPs on average outperformed C Corps, as you can see by the AMZ performance down only 1.2% versus roughly 4% for both AMNA and AMEI that include the C Corps. That said, all three midstream indices outperformed broader energy as E&P, oil services, and the combined S&P sector ETF were all down between 5.7 and 6.9%. Clean energy brought up the rear, down roughly 7.5 to 8% for the month. On the commodity front, crude oil was down 2.3%, while natural gas was actually up 2.3% after getting smoked during January. For the year, natural gas is still down almost 40%. Likewise, global LNG prices were down big in February, with the Dutch marker down 18% and the Asian marker down almost 25%, and both are still down massively year to date. And that begs the question, what's been going on with natural gas prices over the last few months? And the easiest answer, frankly, is the weather. US temperatures were about 15% warmer than normal in January. And in Europe, they recorded their sixth warmest February on record and the warmest January ever, going back to 1910 when the data started. As a result, European gas inventories held up better than people expected, and Europe avoided that worst case scenario that many were afraid of following the loss of Russian gas supplies after the invasion of Ukraine. So weather was definitely a very big reason for the price declines. However, we'd also like to mention another factor that impacted US levels in prices, and that is the Freeport LNG facility that has been down since June 8th following a major fire. Freeport uses about 2 billion cubic feet of natural gas. Before the fire, natural gas inventories were about 330 billion cubic feet below the prior year and actually closing in on the 5-year lows. Freeport was offline for approximately 250 days, which equates to 500 billion cubic feet of total demand that disappeared over that period. If we add back those 500 billion cubic feet, one could argue that inventories would be in a slight deficit versus last year, as opposed to the 471 billion cubic foot surplus that the EIA just reported last week. As a result, natural gas prices may not have been as negatively impacted as we have seen. Freeport is just now beginning to ramp back up, so we will keep an eye on the balances going forward to see if the market does tighten up a bit. The good news for our space is that natural gas prices don't really matter that much to energy infrastructure equity prices. Long-term, the correlation of the indices to natural gas is effectively zero. And as we show on this table, correlations to crude oil are actually higher than natural gas, even for those companies that are predominantly natural gas oriented. Even the short-term 3-month correlations have been higher to crude than natural gas. And this was during a period in which natural gas prices fell from almost $7 to $2.75. Longer-term correlations to crude are more than twice as high as natural gas for those gassy names. So to reiterate, oil prices continue to be the larger sentiment driver than natural gas for our space. Turning to earnings season, we heard management say on a lot of calls that they are now at or below their long-term leverage targets. Enterprise actually lowered their long-term target to 2.75 to 3.25 times from 3 to 3.5 times. In terms of guidance, not every company does guide, but for those that do, 83% of the guides were in line or ahead of expectations. As far as capital returns go, it seems that dividends have become the preferred method for returning capital to shareholders over buybacks. Although buybacks will continue, they just may be more opportunistic than systematic going forward. And finally, CapEx guidance did increase for several names in the space. In most cases, it was due to some new projects, which we view as the good kind of CapEx creep, although we did see a multi-billion-dollar cost overrun on TRP's Coastal GasLink project, which is the bad kind of CapEx creep. Overall, though, we do not believe that the CapEx trend indicates a loss of capital discipline among management teams, but rather companies identifying strong economic opportunities to grow their footprint over time. Thank you for your time. If you have any follow-up questions, please contact your Westwood representative.